Hello and welcome to the 4x4 process. Video 1 is an introduction to the 4x4 process. Here the priority of building a process is to make money over the long term. I call it 4x4 process, but could have been the whole weather process as well. As we will see later, economies goes into cycles, same as equity market, same as any asset classes. What is important is trying to identify those cycles and which effects they do have on regions, asset classes, meaning which regions, which assets will benefit or suffer. Very quickly, let me share my background with you. I have more than 18 years of experience in asset management and prop trading, both on a long-only product and long-short product, and I've done both classic asset management, hedge fund, and prop trading, trading all asset classes with a focus on stocks with a multi-strategies mandate. And I've never been a market maker, i.e. I've never been making money on commissions, so really everything was done on P&L. So the 4x4 process. The first thing I want to do here is use my experience across all asset classes. The core strategy will be around stocks with 60% plus depending on market conditions, and we will look at all asset classes and their possible risk returns. For the universe, we will get exposure from small caps to big caps, FX, commodities, across sectors and across regions. So we will use options, futures, stocks, FX and commodities. Again, all asset classes. I do have like 18 years experience, as I said before, through different economic cycles and market conditions. So, for example, I invested during different market conditions with the burst of the internet bubble, 9/11s, the low volatility environment from 2004 to 2007, which was very similar to the one that we had in 2016 and 2017. I traded during the great financial crisis of 2008 and 2009 from low to very high volatility. The second thing that is important here is by having a no constraint mandate, I was able to have access to any asset class through asset allocation and or sector rotation. The 4x4 process is about different time frame and mandate. Through all those years, I invested short-term with proprietary trading, mid to long-term at a hedge fund, on a long-only product, on an index product, on absolute mandate, meaning long-short. And my asset under management went from 1 million to 3 billion for overall funds. So I was part of funds that were managing overall 3 billions. So what's my situation versus most retail trader process? So first thing first is, why are retail traders failing? I think they do not have a real investment process, or they only think that they have one. So examples of so-called strategy based on technical analysis, or trading the news, or trading the top 3 stock on the day versus the bottom 3 of the day, or they will be following Twitter accounts, or they will be following gurus on internet. Here, if you are watching these videos, you want to learn a real process, either because you lost money in the past, or you are struggling to make money, or you want to get to be making more money. The second thing that retail traders are missing is they lack a robust infrastructure. And as we will see, before doing anything, we want to make sure that we have a strong infrastructure. Plus, they do not follow any risk management. They don't have any stop loss, they don't have any diversification, they get huge concentration. They lack experience and have little knowledge. They hold little patience and think that they can make quick and easy money. So that's really, what we all see and seeing all those videos of so-called traders driving funny cars, and they show low commitment. So let's have a quick look at what makes a retail trader and what makes a pro trader. So on the left hand we get the retail trader, and on the right hand we get the pro trader. The first thing the retail trader doesn't have is a salary. He trades for an income, versus the pro trader that is on a salary. The retail trader is his own boss, which is good and bad at the same time. We'll see later. I think what's important, and that's a big plus for the retail trader, is got an absolute mandate, whereas the pro traders got a specific mandate. Downside is retail trader don't have a process, whereas a pro trader has a really strong process. Retail trader has one retail account, where the pro trader most of the time will have different prime brokers, a strong infrastructure with direct market access, a dedicated line, us and them direct access to the market, and IT support. There is single to no strategy, whereas the pro traders get different strategies. The retail traders get most of the time a very short-term trading approach, whereas the pro trader go from short-term to long-term depending on mandate and volatility. There is a very bad risk management, as I mentioned before, with 1 to 2 position for the retail trader, whereas the pro trader does have a strong risk management, limits, stop loss, drawdown, leverage, concentration, as we'll see later. And finally, the strategies for retail traders are based on technical analysis, noise, tips, whereas pro trader will use top-down special situations, triggers, having a strong commitment and waiting for setup. So here I can give you 2 examples of one of my ex-mentees that before joining my mentoring program lost 70% by buying the Bitcoin at the all-time high and keeping the position, saying, okay, it's going to come back. Yes, but in between it lost 70%. Another one in 2015 just read an article in the newspaper with one of the E&P company that made a discovery, an oil discovery in Africa, and he bought the stock. But actually the news was already in the market, so he bought the stock at the top, and then the stock went down by 50%. So let's look at the retail traders' numbers. In October 2014, the French regulator, called the AMF, the Autorité des Marchés Financiers, released a 4-year survey on retail traders. And their findings were very interesting. 90% of 15,000 customers lost their money. The average loss was 11,000 euro, the median loss around 2,000 euro, and the total loss was around 161 million euros. So as a retail trader, if you do not get access to a professional process or to any process, you have 90% chances of losing all your money. That's simple. So this one is very interesting research that shows how badly retail traders are doing. They have very little knowledge, and this very little knowledge creates very bad risk management with extreme risk taking. So idea here is not to do a blaming game, but just to give you the full picture. So here we get this chart done by IG, and obviously this is a chart that they're probably not very proud of, where it shows that most of their clients, here you can see 43,000 clients out of versus 34,000, are losing money. And you can see that the losses in red are much bigger than the winners. So that tells you the clients get more losers, and they are more often losing money. Here you do have like the same warning coming from another retail trader telling you 80% of retail CFD accounts lose money. So everything here is factual. So versus all those losses, the regulators worldwide had to do something. And one of the things that they have been applying, they have reduced massively the leverage. So in August 2018, the European regulator decided the following: to leverage limits on the opening of position by retail client from 30 to 1 to 2 to 1, which will change according to the volatility of the underlying. So 30 to 1 for major currency pairs, 20 to 1 for non-major currency pairs, 10 to 1 for commodities, 5 to 1 for individual equities, and 2 to 1 for cryptocurrencies. Plus a margin clause out rule on a per account basis, a negative balance protection on a per account basis, a restriction on the incentives offered to trade CFDs, and a standardized risk warning, including the percentage of losses on the CFD provider's retail investor accounts, as we've seen just before with the 80% losses. Same in the US. The US regulator is trying to limit the downside for retail traders, where for stocks you can have with 25,000 USD you can be using a 4-to-1 leverage, but for day trading only. Otherwise the leverage will only be 2-to-1. So one of the way to avoid this non-leverage is by using options, and as we will see later, the idea is not to be using crazy leverage, but to be using options to give us some leverage, and especially for stocks to do a better risk management. For Forex, Forex is regulated in the US by the National Futures Association, the NFA, where the available leverage is limited to 50-to-1 on major currencies and 20-to-1 on the minor currencies. So let's look at the whole weather process in 3 points. The first point is you want to survive any market condition. Retail traders, as we've seen, do not have proper risk management. Pros do. So the biggest failure done by retail traders is having a bad management. And here the risk management is key. The second point that is fundamental is invest in different asset classes. By generating ideas across different asset classes, you'll be able to diversify your portfolio and have multiple investment horizons. So here diversification is fundamental both as risk management and from a market opportunities perspective. Then the last point, I want you to target between 0 to 15% return before leverage. Investing is really a marathon where you want to limit your downside and optimize your upside, and risk reward here is crucial. So when you're done a year, you don't want to be more than 10% down. For example, my worst year was being done by 3%, and I always try to target between 0 to 15% with an average of around 8%. So keep in mind that this is before any leverage. So this is in complete opposite from retail traders using leverage platform, FX, equities, commodities, and blowing up when volatility spikes. Here the volatility will be a source of opportunities, and we'll try to benefit from this increase of volatility. So the aim is to implement a process making money in any market condition. So the whole weather process can be seen as limiting the downside, maximizing the upside, and building your own infrastructure. So a first priority as investor is to define our mandate. Question we have to answer first is, what can we trade? And here, as we will see in the next slide, it's mainly articulated around regulation, setup, and broker. To verify first if your broker is good, you can use this NFA website and look at the validity of your broker. For the broker, choose a strong broker. Look at their risk management and their capital structure, and it's very important to check your broker's regulatory status. The second question we need to answer is, how much capital can we deploy? Based on the length and size of disposable capital, we will decide about diversification and/or concentration, investment horizon, and risk allowed. Then, finally, the last question is, what returns are we expecting? Here, we factually need to assess the asset class risk return, and that's something that we're going to do in the next videos. So the mandate, what can we trade? First thing first is the regulation. For example, if you work in finance, you'll be limited by compliance. If you work for a company, you might have access to insider information. As we have seen before, different regulators could mean different leverage and access to asset classes. The second one is about the setup. You will need an infrastructure that is adapted to your trading strategies with IT, so meaning your screens, your computer, your direct access to the market or not, your internet connection, access to information, live versus delayed prices. And then what can we trade? Through the broker. Here, as we've seen right before, there is a vast offer. The first thing to check for me is how financially sound your broker, as it is holding your money. So here you are carrying a counterparty risk. Then, after checking if the broker is financially sound, you need to verify all possible commissions and tariffs attached to your trading. So the mandate, how much capital can we deploy? And why is it important? Because that will dictate our diversification and our concentration. As we've seen before, retail trader first mistake will be to put one single position in the stock, or FX, or Bitcoin, or any other asset class, and sometimes with leverage like people will do for FX trading. So we have all heard about stories of people, you know, leveraging £500 on one currency 100 times or 200 times, and if the currency is moving by 0.1%, they will lose all their money. The second thing that is important is what's our investment horizon. Here you need to make sure that you will not need the capital you are deploying before the end of the expected time frame. And finally, what's your risk appetite? Depending on your global wealth, your age, your risk appetite, you will allocate different amount of money. So something that is fundamental in the mandate is what are the returns that we could expect. Obviously, depending on time horizon, macroeconomic analysis and market conditions, we will evaluate the possible expected returns. For example, as we say here, there are more drawdowns when economy is growing, but drawdowns are more important when the economy is in recession. So for the non-recession, the left hand, we can see that there are much more drawdowns. But those drawdowns are much smaller than the right chart, where there are few of them, but the numbers, we are talking 55 drawdown like in 2007 versus the worst in 1987 by 33%. So as we see here, we will have to identify where we are in the economic cycle. Same thing here with the mandate and returns expectations, and from PIMCO, like the previous one. As you see here, depending where you are in the cycle, you will not be investing in the same asset. So on the first part of the expansion, equities and credit do very well. As we see here, equities do well. In the second half, as we can see, the 10 years is not doing well. So bonds are not doing well, but they will do very well in the recession. And that is important because that will tell us, you know, what could we expect of from asset returns depending where we are in the cycle. So assumptions for you are the following. We are not benchmarked. So for us, this is not a beauty contest versus an index or the industry. And here, that is a positive because it's very different from a prop trader who needs to be active or a fund manager who needs to show his exposure. The second point that is fundamental is we have an absolute return mandate. Only thing that matters is how much money we are making. And to do that, we have to evaluate the performance over the long term, still on applying strict risk management on different time frames. So what matters here is to make money. That is all. And the last point is we are our own boss. So we don't have any obligation to show exposure or IDs on a monthly report for clients like asset managers or fund or hedge fund manager are doing. And we don't need to put a position just to justify our books limits. That, you know, happens very often when you are a prop trader. So after defining a mandate, we are now facing two major choices. Which asset class should allocate capital to, and which strategies should we use? For the allocation, this comes after reviewing the current economic cycle and its impact on asset classes prices, our current risk appetite and resources, and the risk return of each of them. For the strategies, here we do not want to be prisoner of only one strategy or one market condition. Financial markets, as we will see later, are always evolving, and our job is to be factual and reactive. So what about the different asset classes? They are what we call the listed asset classes and the non-listed asset classes. So for the listed, as you see here, stocks, equities, fixed income, bonds, foreign exchange, cash, which means money market instruments, commodities, and gold. Gold is is still a commodity, but is seen as sometimes as an asset class on its own. On the non-listed, which is real estate infrastructure, you will still be able to find some products that give access, some listed products that give access to those two asset classes, but most of the exposure will be non-listed. So the different strategies to use. For each strategy used, a trading plan is required. The trading plan is core for being as successful as a professional trader. Idea generation is fundamental, but implementation is as important. As I said very often, an idea is not necessarily leading to a trade. So in one of the videos that will be included, and this video is called the most crucial part of a trading plan, we can summarize that first we need to define the implemented strategy. Then we need to put the odds in your favor. Then we need to define the sizing and allocation, assess the risk reward, always predefine a hard stop loss, and here this is fundamental to me, and this is extremely important, risk management. Then keep an history of your trades and analyze them in trying to get better, and make no mistake, emotions will interfere. So from my absolute return experience, to be successful in the long run, we will need to use a combination of top-down strategies, bottom-up strategies, and active trading special situation process. The top-down investing or macro investing, we will be looking at the big macroeconomic picture, i.e. the overall economic outlook. Top-down is about identifying the different macro drivers and possible future triggers. By doing so, we will be looking at sectors in growth or in recession. With this macro process, we will identify global regional opportunities in which specific countries to invest and allocate capital between asset classes. So for stocks, as examples, top-down will lead to the following process. We'll start with a macro view, then we will scroll down into sector view, then filtering down into industry view, and then finding the right or the bad stocks. The top-down investing, in a top-down investing, what you want to do is you want to build a full macroeconomic picture at an instant T right now with what happened before. So that is what we call the lagging indicators, -1. The coincident indicators, that are all the indicators right now. So that gives you -1, and now that gives you the current macro picture. And you are trying, as an investor, you are trying to forecast what's going to happen in the next 3, 6, 12 months. And to do that, you'll be using what we call the leading indicators. And we will see later in different videos, you know, lagging indicators, coincident indicators, and leading indicators. What about the bottom-up strategy? Instead of taking the economy from the top, what we are trying to do here is we start from the bottom. It is called asset picking or stock picking. Bottom-up is about analyzing individual companies rather than a sector or industry or macro conditions. The idea behind bottom-up is to identify companies that could perform or not perform based on their intrinsic characteristics rather than their industry's performance or global economy. It is mostly for stocks and for corporate bonds, and we will combine a quantitative and qualitative analysis. Finally, what we want to use and what we're going to use in this process is active trading and special situation. Here, the objective is to add performance to our portfolio with an active management. Capital projection through active market timing, so using markets volatility, identifying risk on versus risk off, looking at indicators like the VIX. Depending on market conditions and opportunities, active trading and special situations are keys for performing in the long run. Active management of our portfolio is essential for risk management and performance. The degree of investment exposure depending upon opportunities and risk return profiles. And we can name already some of them. Of those strategies will be ADR arbitrage, options expiry, index rebalancing, IPOs, rights issue, split, M&A, and so on. So let's look at the picture now. So when we do top-down, we'll start from the top of the economy, and we split our allocation into different assets or different regions. Asset and regions. And we will go into the 7 asset classes, keeping in mind that it's hard to have access to 2 of them. Then we carry on scrolling down from bonds, if we are looking at bonds and stock, and we go into sectors. Then from the sectors we will go into industries and into company. And to avoid to be missing many stocks or many good stories or bad stories, we will use as well a bottom-up and special situation trading. So the trading and special situation will give us access back again to whole asset classes, and bottom-up we will again start from the bottom, so from a company, we go into the industry and the sector. But all of them will have to be done with the portfolio construction, the risk management, the price action, and technical analysis. So the benefits of the 4x4 process. First thing first, this is a multi-criteria process. This is across asset classes and geographical regions. It is a great process as it will go hand in hand with your learning curve by adding new countries, new sectors, or new strategies and new companies. The second point and second benefit of the 4x4 process, it's a multi-market conditions criteria. This is a process not only based on macroeconomic and puts big weight into market conditions. So I'm a big believer that you need to listen to the market and you need to really follow what the market is telling you. The third benefit of the 4x4 process is avoiding limitations of any strategy. If you only do top-down, you'll be missing probably most of the time 70% of the stories that are out there. If you are not looking at all those possible strategies, you'll be stuck in one strategy that will only work for a certain period of time. So conclusion, what do we need if we want to start trading? First, we need to be flexible. Market is always different. We need to identify potential triggers. We need to be nimble. It is all about an endless learning curve. You need to have a strict risk management. And as we'll see in other videos, we'll be talking about leverage, concentration, and stop loss. Here, this is a big difference between the pros and retail. Strict risk management. We will be looking at different strategies depending on market conditions. We will use discretionary. My personal conviction based on experience is that passive investment and quantitative strategies do not work in the long run. So you need to be flexible. You need to adapt your style to the market's reality. Something that is crucial is you need to build your own infrastructure, and then when your infrastructure is ready, you can be starting to invest. So overall, the 4x4 professional investment process summary. First thing first, ID generation across global asset classes using top-down macro analysis, bottom-up analysis, active screening, trading based on market conditions, and special situation. Then we will go into the portfolio construction around a core that will be based around stock. Then we will have a multi-assets depending on opportunities, with a quantitative process, qualitative process, technical analysis, price action, risk return, and looking always at the economic cycle. Finally, what is fundamental for us to make money and to make sure that the capital is not going to be destroyed is to use a strong risk management. And here will be very similar to real professional to avoid retail traders' mistake with a flexible time frame. Thank you very much. See you on the other hand.